Thanks for joining ACCA F9 course. Today is the X class, which is the last lecture on the materials on the study notes. And after this class, we will go through the questions, the past paper questions that we would like to have the revision with all of you to let you understand what's the requirements and what's the solutions of those questions. The agenda today, first of all, we would like to go through the investors' ratios in financial management as well as the financial management objectives. The second topic, we will talk about the non-financial objectives. It is very important for us to know both financial objectives and non-financial objectives in financial management. The third topic today, we will discuss the agency problem. Okay, for example, the management of a company is an agent of the shareholders to manage the company. So there is an agency problem if there's something wrong in the management's objective. Next, we will go through the not-for-profit organizations and what's the target of those not-for-profit organizations and how to manage the objectives of those organizations. Topic 1 to 4 is about the financial management functions. And from the fifth topic, economic policy and objectives, to the financial markets, we talk about the financial management environment. For the economic policy and objectives, it's about the government policy or the economic policy like monetary policy, like fiscal policy, like competition policy, like green policy, how those policies and objectives affect the company's financial management decisions. And next, we will talk about the financial intermediaries. We will discuss what the financial intermediaries are and what their functions and roles in the market. And also the last topic we discussed is about the financial markets. And financial markets is a very important part for the financial management environment. Financial management objectives and the relation and the with investors ratios in those financial management topic. First of all, we need to define what is financial management. Financial management can be defined as the management of the finances of an organization in order to achieve the financial objectives of the organization. So here we talk about some important issues or important topics. First, we have to know financial management. From our first class, talking about the investment appraisal, to our last class, talking about the business valuation and also the efficient market hypothesis, all those materials or theories that we discussed is about the financial management. So right now, we would like to have a conclusion by introducing what is financial management or what's the definition of it. Financial management is the management of finances of an organization. So for an organization, it can be a company. It can be not-for-profit organization. But if we look at the company, then the financial objectives of this organization is maximize shareholder wealth, okay, a lot of people know that the financial objectives of a company, a profit-making company, is to maximize the shareholder wealth. So the usual assumption in financial management for a private sector is that the objective of the company is to maximize the shareholders' wealth. So how to maximize the shareholder wealth? In our first class, which is a very important topic, we described about investment appraisal. Right? We described about the cost of capital. Okay, we also mentioned about working capital management. We also mentioned about risk management. Okay, all these topics that we discuss in our classes is to maximize shareholder wealth, because we believe that the wealth of the value of a company from the business valuation we believe that discount cash flow model. All right, discount cash flow model, we believe the best way to do the investment appraisal is NPV. We select positive NPV projects. All those theories and work from what we learned is to maximize the shareholders' wealth. So here we just summarize the assumption in financial management is to maximize shareholder wealth, because what we learned is the tools like investment appraisal, like working capital management, risk management, all these are to maximize the value of a company in which the shareholders' wealth can be maximized. Also, the cost of capital. If you remember, we tried to have or to achieve the lowest of cost of capital so that our net present value of the projects can be maximized as well. So here, just to describe what we learned in order to achieve our financial objective, the maximized shareholder wealth. And financial management decisions cover investment decisions. As we learned, financing decisions is about the business finance. Business finance include costs of capital, include sources of finance. All right. Dividend decisions or dividend policy. For dividend policy, it affects the value of the company as well, because do you remember the dividend growth model? It will have it can derive the value of a company, the P/NOR. And also financial management decisions cover the risk management. We mentioned about the FX, the foreign exchange rate risk, and interest rate risk. We mentioned this topic. So remember what you learned here, is all about financial management decisions. And here, we talk about financial ratios. Financial ratios is used to analyze company performance as well as an indicator for external finance providers. Here means, for example, the bank or debt holders. First, we would like to introduce returns on debentures. The basic principle is if you hold a debenture and the market interest rate is going up, what's your impact to your bond price? It's going down, right? As we learned before, it's going down. So here, just the logic to describe the relationship between the interest rate or the yield. I should use the yield rate and the bond price. And anyone who holds such a debenture can calculate the rate of return they will receive applying the following formula here. Okay, rate of return means the interest receivable divided by the price paid times $100. And the interest receivable may be a floating rate note or fixed rate note. Okay, a lot of our examples sharing with you before is about a fixed rate note. Okay, for fixed rate note, it means the interest receivable is fixed, and then you can know, and you will be given the price in the questions to calculate the rate of return of buying debentures. So if, for example, if the price is low, like for example, if you buy the bond at the interest rate, for example, at the peak, say for example, the interest rate is 10% is the peak, it means your price is lower. All right. Then your rate of return is much better for the other investors because you buy at the lowest price for that bond or for that debenture. So this is the formula how to get the rate of return for the debenture. And here in an example, if an investor buys £1,000 of nominal value of 10% Abbey National PLC debentures and pays a total price of £1,250 for it, then they will receive interest amounting $100 per year by applying the formula shown above. Then rate of return is 8%. Okay, because here's the price you pay, and here is the interest receivable. And you have to know that when the price you pay is 1,250, which is more than what the nominal value at 1,000. So it means the interest rate is dropped lower than initial interest rate. Because the price of the bond right now is higher than the nominal value. Okay, because the price right now is higher than nominal value. If you remember what I mentioned is the relationship is interest rate. If it's up, then the price is dropped. So on the inverse, when interest rate is going down, the bond price is up. Okay, so here the relationship I think you have to remember before you go into the examination hall, because it's quite important to understand the relationship between the interest rate and the bond price. Next is about the returns on equity. We have a lot of definitions covering returns on equity. For example, earnings per share. The first method is EPS, which is it is the headline earnings per share. Okay, what we learn is profit after tax here. After tax minority interest and preference dividends divided by the number of shares in issue and ranking for dividends is the number one, the earning per share that we can get from the accounting or from the financial statement. The second is the PE ratio or PE multiple, which we describe in the business valuation topic. It is the ratio between the current share price and the headline earning per share. We also mentioned about dividend cover. So here is the term you understand. The dividend cover is the earning per share divided by dividend per share. Say if EPS is 30 cents and dividend per share is 15 cents. So 30 divided by 15, which is 2. So dividend cover is 2 times. So you can take the average to see the industrial or the industrial average. And see whether 2 times is a high dividend cover or low dividend cover. And here show you the formula showing EPS and DPS. Then we get the times, how many times. So fourth, the return, how to measure the returns on equity. We cover the dividend yield is the DPS, the dividend per share divided by the price per share. Okay, is the yield. It means if you pay, say, $2 to buy the shares in which the dividend per share is, say, 50 cents or 0.5, it means 25% dividend yield. Is quite high, honestly. So a lot of the time is we pay the price is $2, and the dividend per share maybe only, say, 10 cents. So the yield is 5%. It's still high. All right, still high, because in a lot of our survey or study, the dividend yield is between, right now the market is between 2% to 3%. A lot of the shares or a lot of we call the blue chips company, okay, which they have the largest market value in terms of the size. The average dividend yield for those big companies is about 2% to 3%. And last but not the least, how to measure the returns on equity. What we discussed is about some principles, for example, like the ROCE, return on capital employed. Just to recap, the return on capital employed is profit before interest and tax divided by the capital employed, and the capital employed means the shareholders' funds plus the long-term liabilities or the total assets less current liabilities.